There are two primary ways to arrive at the EBITDA figure. One starts with a company's net income, and the other begins with its total revenue. The first method, often called the bottom-up approach, starts with a company's net income. Net income is the profit a company has left after all its expenses, including the cost of goods sold, operating expenses, interest expense, and taxes, have been deducted from its revenue. To calculate EBITDA using this method, we take the net income and then add back the interest expense, the taxes, the depreciation, and the amortization. We add back these expenses for specific reasons. Interest expense is added back because we want to see the company's profitability before considering how it chose to finance its operations, whether through debt or equity, as the capital structure can vary significantly between companies. Taxes are added back because we want to evaluate the company's performance before the impact of different tax rates and tax jurisdictions. Depreciation and amortization are added back because they are non-cash expenses, meaning no actual money went out the door during the period for these costs. They represent the accounting allocation of the cost of assets over their useful lives and relate to past investments rather than the current period's cash generation from operations. The second method to calculate EBITDA is known as the top-down approach, and it starts with a company's revenue, which is the total amount of money a company earns from its sales of goods or services. From revenue, we first subtract the cost of goods sold, which are the direct costs associated with producing the goods or services sold. This gives us the gross profit. Next, we subtract the operating expenses, which are the costs incurred in running the business, such as salaries, rent, and utilities. But importantly, when using this approach, we exclude depreciation and amortization from the operating expenses. This step leaves us with operating income, which is also sometimes referred to as EBIT, or earnings before interest and taxes. Finally, to arrive at EBITDA, we add back the depreciation and amortization expenses to the operating income. Ideally, both the bottom-up and the top-down methods should result in a similar EBITDA figure, providing a more robust understanding of the company's operating performance. The bottom-up approach shows how much of the final profit is influenced by non-operating items, while the top-down approach highlights the efficiency of the core business operations before these items are considered.